Hey, guys. So wanted to go over some hedge strategies and a little bit on what happens to the analysis graph if you do a few of the different hedge strategies that I'm looking into. And then I'll leave it open for questions. Let me open up the camera right here. So two main strategies that I do. I'm gonna leave the video after the end here. So two main strategies I do are when the market's down a bit and or the VIX increases like today, market's down over 1%, and if the VIX goes up, around 10%, we easily hit both of those. So I took this trade on where I sold one MES at a zero point 0.2 delta, took in 60 credit on that, and then I buy one ES put. I can't do the analysis tab on ES and MES together. I'm not sure if there's a way around that. So I just did 10 MES. This is the same as one ES anyway. And I bought that for half of the cost of the sold put. So in the end, if the naked put expired worthless, although I'm not going to hold it that long, but if it expired worthless, the bought put will be more than covering that. However, if the market drops a little bit, as you can see in this green line here, this is like the valley of death where it's hard to get out of it. And this is at expiration at least. This is where you could lose money on the trade, even if the market drops, just because the sold put is a lot closer to the money than the really far away bought put. That's 3,300. However, just looking at a big volatility event, I just looked at 40% increase in volatility, and then you could see the strike prices here. If we go down to around the 5,500 or around even 5,000, this is today. As it goes closer to expiration, we'll get closer to the green line. So if you wait a few weeks, it might be somewhere around here. You can still make a few $1,000s on the trade. And that's mostly because of the volatility jump, where that bought ES put will be worth a lot more than the sold MES put. Does that make sense so far, Kenny or JJ? Can I mute your mics? No.
Yeah, yeah.
Okay.
Yeah. Definitely, Lance.
All right. So in this one, with just a 40% volatility jump, which is theoretically not a ton, it could easily go higher than that. Just today it went up, what, 20 something percent in a day. The volatility event will increase. And I'm going to be looking to close out that 5250 sold put at 50% profit. So if I close it at 50% profit, it pays for the 3,300 strike. And then it's a free, essentially paid for hedge against big volatility jumps or down markets. If the market drops a bit and the 5250 put ends up getting at a 3x loss, I'm going to take it off at that point, at least the sold put. The bought put might be worth more or it might not. It's too hard to actually tell on that just because the market could drop a little bit. The 3,300 is still so far out of the money. If there's not a volatility jump, then it may not be worth much more. So it could end up being a losing trade in the end if the market drops a little bit. So just be aware of that. Again, this is 40% increase in volatility. And then this was 50% increase in volatility. The y-axis kind of shifted a little bit. Where here, if you're at around 5,000, a 50% jump, we're at 6,000 or so dollars. So it could be a good way to offset any, losing positions in your sold options. And that's what the main goal in this is you're not trying to necessarily make money on this trade. You're just trying to offset the losers. And also it helps your buying power because you have that one ES bought put that will help a lot with the buying power reduction if it drops that much. Another trade that I'm looking at, yeah, JJ, go ahead. So you raise your hand there.
Yeah, thanks, Lance. I didn't mean to interrupt you, but just a quick question. So, yeah, when you say when if the volatility goes up by 40 or 50%, I'm just curious because I don't recall that was a crazy day on August 5th. how many percentage points did the volatility go up on August 5th or the
Well,
August
it was
4th?
over 100 because we were. I don't remember at the time on like Friday evening or so. I think it was in the low 20s or high teens. And then the peak on Monday, about 30 minutes before pre-market, it was at 64, 65. So that was what, 250% increase in that.
Right. Yeah, that's what I was thinking. It's considerable, right? So if I know that we're looking at, let's say, 40 or 50% increase, but if we have another, let's say we have another move, not as bad as August 5th, but let's say half of it, half as bad. So VIX jumps to 30 in a day or
Right.
35. How would we adjust the numbers in this analysis with Thinkorswim to see how this profit loss graph
Yeah.
would look? Like,
So you could just type in the numbers. So if you put in the trade and then right click analysis, view analysis of it, and then on the right, you could do the vol adjustment tab. This is where you could change your volatility numbers. Essentially, when the volatility increases, this line shifts up, especially on the same
right.
T0
So,
day.
so your numbers might even jump large to be bigger profits if we did see, let's say, 100% increase.
Yeah,
Like,
it would be. It would be even higher. I'm just trying to find some reasonable ways at 40 or 50%
right,
because sure, it could go up 200%, but it's going to be a very rare event. A more likely event might be a 40, 50% jump. But definitely fiddle around with the Thinkorswim analysis tab on that so you can see.
that profit level looks nice, whether it's 15,000 or 30 plus thousand. That's a nice looking price graph there.
Yeah. And then again, we're trying to offset losers because you're going to be losing on some of your sold options. And then if you're ideally going to stop out a 3x loss on the sold options, we're just trying to find ways to offset most of those losses. And this is one way to go about it.
Right,
Um, Another way is doing the 3-5 hedge. This is starting off with a 12-20. So you don't want to start off with a three sold, three and five bought, just because if the market drops, it's not looking good with those sold puts. So you want to start with a 12-20. This will be for an initial debit. But then after that, we could try to add on three sold puts and then buy back the initial sold and just keep going with the 3-5 ratio. Essentially, you're trying to keep selling three. You want to buy five for the cost of the three once you close those out, and then you keep the five on pretty much. So the goal is to have a lot more bought puts than sold puts in the end. This is just the initial 12-20 if you're thinking about starting it off. The debit was around six. So for ES times 50, you're looking at $300 or so. Obviously, the numbers could be a little different when you get in. So probably will be a little bit more than that. But if you can see on this chart, pretty much is at a net profit pretty quickly at just a 20% vol increase here, where just at the market, you're already at a few $1,000 gain, and it could easily increase from there as well in the T0 line in purple. I think the next slide is a 3-5. Um, if you see in the 3-5, obviously the gains are not going to be as much because you don't have as many options, but still looks like a pretty good graph to start off. Again, I wouldn't recommend starting with a 3-5 just because you can't sell the three sold right away. If you sell three more, then you're selling six for five bought, and then you're actually going to get hurt quite a bit on a volatility jump. So if you start with 12-20 and then you sell three more, you're at a 15-20, which is still not great, but at least you're not having more sold than bought. And then the goal is to buy five more bought. So then you'll be at 15-25. Essentially, you want the ratio to be 60% or less on the sold compared to the bought. Definitely helps to read through the Black Swan hedge guide if you want to understand more on that. Does that all make sense? Any questions on that? Kenny,
Not
Lance?
so far.
what
Yeah,
if you don't mind, Lance? Yeah, so just like looking at the 3-5, what type of margin requirements do you think that would have to
it's not
you'd have
much
to?
at all. It's pretty low. I'll just post it in on Tasty right now. So ES, I forgot the exact numbers. Typically you'll go around 70 days or so because you want to find 50 widths. If you go further than 73 days at the really low deltas, there's only 100 widths. 50
Right.
widths usually is better. Um, I I could look it up. I think the exact it's around three or so that you're selling for premium. Let me see. I'll get it. Just give me a minute. You're essentially selling three for around three, so you get nine premium total, and then you look to buy to close those back at around 20 cents. So it ends up being about 2.8 times
All right.
three. And then when you do that, you could buy the five, essentially. Let me try to find it. All right. I haven't done these yet, by the way.
That's fine. No, no. I just thought you may have known off the top of your head. I was wondering if you needed, let's say, is that a $10,000 buying power requirement?
It's
Maybe
not that much.
5,000. No.
We'll look it
Okay.
up. We'll look it up soon. So you sell three puts at $3 for 450. You sell three at three, it should be nine. I don't know if those numbers make sense. Let me look at the $3 though. So if you're gonna start it off, you would sell, it's hard to say at the bid ask right now. Probably around the 2,700, I'm guessing. When the market's open, it'll be a little easier to see it.
Yeah. No worries.
So 100 width again. That's not good. Probably to go a little less DTE. And I'd prefer not to go around 58, but just to show what the BP is. Um, I already have one. If you sell around three, it's a little high. 3150, change the quantity to three. Then you're gonna take the buying power is only $2,000 to start the trade if you're already have the 1220 on. If you wanted to start the whole trade off like right away, you're gonna sell 12 of these and buy 20, 50 with below it. You only need, you actually get a credit. This shouldn't be, I don't think it's a credit. It might be a credit, but you're actually paying a debit to enter the trade. It's hard to know with the bid ask spreads that are so wide. I think it's a slight debit. It's close to break even, probably in the buying power use, but you will have to pay a debit to start it off, if that all makes sense or not.
Yeah. Yeah, it does. Thank you, Lance.
Yeah. So for this, if you wanted to start the trade, again, the bid ask is so wide, but let's say you get filled in around six, six and a half. You're going to pay about $300 to start the trade. At that point, you want to be more than 58 days out because it's going to take a while for the rest to decay. And you never want to have more sold than bought. Ideally, you never have more than 60% of the sold overbought. So ideally, you could go further out in time. But unfortunately, they don't have that at a 50 width unless you go to like 2950 or so. This might be better.
So if you don't mind me saying, I built it while you're talking, and in Thinkorswim with my, I don't have portfolio margin, I just have span margin. The
Yeah.
trade is a 3.5 using your numbers,
Yeah. What's
uh,
the BP on that?
the 3150 and a 3100. It's going to cost $360, and it's
Right.
going to use just $360 in buying power,
Yeah.
which seems amazing. And the max profit is 302,162.
Oh, yeah. That's if
Like,
the market goes to zero and I worry about nuclear fallout first. But yeah. Well, yeah, technically you're right.
how many of
Uh,
these do we need in our lifetime? That's a great trade.
yeah,
That's a,
that's the initial trade. However, you want to try to build it up so you get even more bought to sold. So then it could really push like really hard after that. Let's assume you already did something like this. What you would do next is on a down day like today, where Ideally, you enter this on an up day because you want to have a little bit better strikes and the premiums won't be as much. So ideally, you already had it on. Then on a down day, you want to sell your three puts. So there you're going to sell three more. Again, you're at 15 sold to 20 bought. It's a little bit of a dangerous situation at first. But at this point, you'd sell for three. You buy it back at 0.2. On the strike below is that. Oh, okay. Don't worry about the good till close yet. You essentially start with this. Then you look at the 50 with strike. It'll take usually 30 days or so. But at around 30 days, you'll see a 2750 pop up, for instance, because you have less DTE. At that point, you want to buy five of the 2750s for 1.4 or so. When you do the math out, it essentially breaks even after all these positions, and then you're left with a bunch of bought puts. And that's what the main goal is. Yeah, I wrote sell three for three premium, buy five puts 50 below it, 1.4 when you can. So you put a good till cancel order in right away. It won't be there right away. You have to wait for the market to decay a bit. And for the if the market doesn't have a volatility event, then the 50 points below will be 1.4 eventually. Um, and then if you just do the math, you buy back the three puts at 0.2. So you're essentially paying, sorry, you're taking in three, you're paying 0.2. So you're netting 2.8 on the sold times three contracts. You're netting 8.4 total on the sold puts. Then if you buy five at 1.4, 1.4 times five is 7. Include commissions too in there. You're essentially at a slight profit when you could do all this. So you're essentially adding the 3.5. Once you bought back the three, you have no more risk because you got out of the sold puts already. And you're left with five puts. Oh, the 1.4, but you have five extra puts. And that's what the main goal is. You're not really trying to do this where you're paying much of a debit. Although, if you need to, at times you might have to add more 3.5s on there for a debit just to keep the ratio good. As you can see, it gets pretty complicated after a while. And that's what makes this tough to do. I still haven't done it yet. I prefer the 1 to 10 ratio one that I'm doing. It's a lot simpler. Sell one at 0.2 delta, 0.50 DT around 50 to 60 is okay. Buy one ES put for half the credit. So then again, you're left with, half the credit. And then ideally you could buy back that sold MES and you're left with one ES. So that's a really good ratio when you're starting. It's a 1 to 10 ratio instead of 3 to 5. So you only have 10% of your sold puts compared to 60%. And then it's pretty simple and straightforward. Whenever you have a down day, add another one of these on. I already did three of these. So let me just show the positions real quick. That was just a separate block. Yeah, it's one of the ESs. Here we go. Yeah, so here's my three bought ES puts that I got. They're really far out in time, but again, it gives good amount of protection. They're already up a decent amount on the actual hedges just because the volatility went up since I entered it. But then I sold the MES that are going to be down a little, I think. Yeah, I mean, this one's already down from today $100. The other ones are down 100 too. So I'm pretty much near break even on the whole thing so far. If volatility shoots up, though, these MES sold puts won't be as much as the bought puts because if I get closer to the money, it's going to be worth a lot more on the bought puts compared to those solds. Does that all make sense?
Yep, yep.
I
Yeah.
mean, ES is worth 10 MES, so it's 50 points. It's $50 a point. So whenever this goes up like one, you're getting $50 off it. and then eventually it could shoot up, especially if you have that good ratio. I'm going to continue doing that 1 to 10 way because it's a simpler way. Eventually, I might do the black swan hedge, but again, it gets very complicated making sure you have the right amount of sold and bought, and you might have to add more in. And you can put the good till canceled orders too. What a lot of people's problems were during August 5th was they had the good till canceled orders on the sold puts, but they couldn't get out of it. And it also used up buying power, which is a bit silly because just by getting rid of the good till canceled order on your sold puts, your buying power went up. It was just Tasty Trade and all these spam margin requirements were having so much trouble figuring out what's happening during all that that's what happens. So just FYI on that. If you end up doing that 3-5 or 12-20, you want to make sure you get rid of the good till canceled orders during the volatility event. This is deep level stuff. Jamie, any questions so far?
No, I just kind of observing the
Okay.
progress still, and maybe I was too quick to get out. I think you left AMD and Google hanging to see what
Uh,
happened tomorrow,
right.
but they hit the alert, and I stepped out on them because I
Okay.
have multiple contracts open, and it was kind of rough.
Yeah. I just got out. I didn't get out of it because I was just too busy teaching. It was hard to try to teach
Oh,
there.
okay. Otherwise, you would have.
Most likely. But Google was pretty close, wasn't it? I think I saw the alert and then it bounced up and was hanging near the alert price. I forgot on the top of my
Yeah,
head.
Google was really close, but like I guess there's just the overall sentiment after I think I took like I don't know, I have 450 or something loss on the AMD one. And
Yeah.
then I saw VIX climbing and I was and Google touched the alerts. I'm like, I'm gonna get that one too. So um I didn't
That's
watch
cool.
Google close. I was watching AMD.
What was the alert for
So I let it
Google?
dance around for a while.
Was the alert around 158 or so? I don't remember the
Um
exact.
I think so. That sounds right.
Yeah, it's very close now. If we're at
Yeah, that sounds right.
157,
158.
if it's at 157 and 155.50 put credit spread, most likely have to get out tomorrow morning. Hopefully there's a good jokes report at the
Yeah.
top, open numbers, but it's too close for comfort. I'm gonna get out tomorrow if it doesn't move out. Yeah, AMD is too. AMD is
Yeah,
only
I wasn't expecting this day, I wasn't expecting a down day quite this hard right now. That was not exactly what I was looking for. So,
yeah,
but I think you posted that thing about the NVIDIA and Department of Justice might be a factor that was driving things down.
yeah, and it might have hit AMD also. I mean the market was down in general, so
Yeah.
AMD, yeah, tries to get out of it.
I mean, I
Like,
knew things could be wonky. I mean, I was expecting them to be a little wonky after the holiday weekend. I wasn't expecting quite this level of wonky that
right,
that would stop me out of a couple things. What wasn't quite on my radar.
yeah, Google's below all the EMAs and below the anchored VWAP. It's looking like I close both tomorrow. That's the lower. If I go even here, yeah. We're quite a bit below the anchored VWAP right now. It's looking like a close. It's too close for it because we're only 2 points away. Yeah, it was probably
Hmm.
worth closing it. You don't want to get to the touch. You don't want to touch the sold pot. This is too much risk to
Yeah.
it, especially since you're only getting 40, $50 off it. It's not worth like touching and then hoping it bounces back. At that point, take your
Well,
loss and move.
yeah, that's what I was thinking is I'm like I don't want this to get bigger to get to a
Right.
bigger loss on here and really get to be a mess.
Yeah. If you're doing multiple contracts, you can consider closing some, like half maybe, and then seeing if the other half work. We'd still have 17 days on these. That's a bit of time. If it was closer, like a week or so, maybe you would just watch it carefully. But yeah, you got to close it out with 17 days left, I think.
Yeah. Yeah. Okay. All right. So it wasn't a bad choice to close those
No, I
then.
think it's fine. If it
All
touches the
right.
alert, if it touches the alert price, almost always getting out is probably okay, just so you mitigate your risk and you don't have bigger losses if it keeps dropping.
Okay.
The only time, if it touches the alert, the only time I might keep it is if there's very little time left, and then it might bounce back or expire worthless at that point. But otherwise, with 17 days, I would get out. It was just
All
bad
right.
time. It was just bad timing on that. Because I mean, we just entered it a few days ago on
Yeah,
June.
I've had a few of those where I've had just bad timing where I think that happened to me with like I think it was Nvidia like a month ago or something that I got in with four contracts and it was like 2 or 3 days later we just shot down hard.
Yeah, that was during the August of that. I stopped out too on it.
Yeah. Yeah, some of those are kind of those are the roughest ones where we get into one of these and it just has a sharp drop against us like a
Oh,
few days because then you don't have any theta working, in your
yeah.
favor. You just that seems to
Yeah,
be about the worst case scenario.
yep, you're learning well. That's true. I mean, you only take a few days of theta decay. It's not going to offset the difference of the premiums when you get closer to the money.
Yeah.
But just move on. Use the percentages to your favor. Yeah,
Yep.
not every trade is going to work. If anyone
Yep.
thinks all the trades are going to work, they're lying to you. Yeah. So yeah. Again, if someone tells you 100% of the trades will work, they're lying, or they're lying. That's it goes. But yeah, you got to play the percentages out. We're I think 80s, mid 80%. So sure, if you stop out near 3x loss on 15%, but you're making, you know, 5 to 7% or so on the 85%, you're still better off.
Yeah.
I'll leave it open for any other questions from anybody as you have them.
These added hedges and being a little more safe, what do you estimate the say for the safeguard or the futures accounts? What percentage a month are you looking for now? Has it changed? You were at what 2.5 to 3% a month
Yeah.
was what your goal
Um,
was.
when the VIX was down to 15 again, like last week, I'm trying to get 1.5, 2% a month. I'm not going for a lot here. I'm also hasn't I haven't calculated the exact amount I would make compared to the net lick, which I probably should be doing. But you can just see the open positions and see how much it might make in the 4 month time period. So if I do a safeguard at 120 days and it makes say 10% in 4 months, that's 2.5% a month. However, you got to factor in how much positions you have compared to the total account. So it actually is probably easier just figuring out the dollar amount of gain and then compare that to the total account size. So if you're at a VIX of 15, we're adding on less positions just because we don't want to get hurt as much when the VIX spike happens. So yeah, I think dollar amount over percent probably makes more sense.
Okay, makes sense.
I don't know the exact numbers. It's hard to say. Also, I closed out quite a bit on the Volkswagen event, so I'm waiting around a while. I have a lot of like 80, 70 days out at this point. There's not too much that's about to close, and they're all MES anyway. So I'm not going to be making a ton right now. Just how the timing worked out. Another factor I got to put into is my account will go down to around 25 to 30 grand on January or so. Because in January, I got to fund my SEPT. I got to pay for an AC bill and, and I'm guessing 30 grand or so. So what that means is if I'm doing 120 days out trades, they're going to start expiring around then. So in the next month or so, I think I'm still good with similar position sizing, but I need to factor in that I'm going to be taking out funds in January. So because of that, I'll probably have to do less positions like November, December, especially.
So
So
when you do those, you'll still give alerts, but it'll
yeah,
just say on paper.
I might. I'm considering I'll still give all the alerts that I normally do on my account, and maybe I'll do a paper trading like 100 grand, 200 grand account, and just show how I would trade that, just so other members can actually understand what
Yeah,
their
that'd be
account
great.
size. I think that's probably a more reasonable way to go on it. And then eventually that paper trade will be real money one day again. Ideally, of
One day
course.
soon. One day soon.
Yeah. But in the end, like I want to make sure I'm doing all of my investing, max out the Roth IRAs, max the SEP, put my 401k match for my wife. All that stuff has to happen before I'm adding to my trading account, just because I know long term it's
And
almost
you do all
guaranteed.
SHAD in that, right?
SCHD, yeah.
Yeah, SCHD. That's what I
I'm
meant.
gonna be adding for my SEP. I'm only doing SCHD just to keep stuff super simple. It's like one fund. I don't even look at it. For my Roth IRAs, I'll probably add a little of that too, just because I'm a little bit lower on those compared to my other stuff. And it might be pretty much only SCHD for like a year or two. I'm gonna put small percents on other stuff, but it won't be that dramatic.
Gotcha.
It's hard to beat out long-term dividend growth companies over decades. Like that is one of the, I wouldn't say foolproof, but as close to foolproof as you could get. Just regularly contribute to good dividend growers that don't dramatically, shoot down like 50% or whatever, and just buy that like every paycheck and don't touch it. It's like buy at least 10% of your, salary. Ideally more, obviously is better. Put it in dividend growth companies, reinvest the dividends into more shares. Don't touch it for 20 years. It's really hard to beat that.
I agree. I like Schwab's other SCHG as a grower too. So
Yeah,
they've got
that's
really
the
two good funds.
that's the growth one for himself, I think.
Right.
Yeah, I gotta look into that one. I already have some SPY and QQQ, so I probably won't do it, but I'm a little bit more small cap value leaning for very long term time horizons. It
Mm-hmm.
shows that it did beat out, although it's been lagging SPY for the last decade or so. But
You talking like IWM
yeah, that's
or the
small cap
Russell?
blend. Yeah, IWM is more of a small cap blend.
Mm-hmm.
Small cap value is I have SLYV. I think it's just
Okay.
later small cap value ETF. There's also Advantage has one. I have the international one, AVDB, I think it is. So
Gotcha.
here I'll share my screen real quick. This is interesting for investing type. So I've been following this guy Paul Merriman for about 10 years or so, and he's done a bunch of research on small cap value as a tilt. You don't want to go all small cap value because there's more swings and there's more volatility. Um, I'll just oh man. The one he recommends for most people is 25% on small cap value, small cap blend, large cap value, large cap blend. And then you could also do that as like 50% of your account. Do the other 50 as international versions of it. And you just pretty much keep it like that. Yeah, this is the asset class comparisons. Look at the 40-year returns. I'm trying to see which one is the. If you see all these different index funds like small cap value, growth and whatnot, um, SCV is small cap value. Percent of the time it performed best and worst is gonna vary. Small cap value pretty much beats out everything in the 40-year returns, 94% of the time. If you go 10, 20 years, it's less. So you don't want to put all of it in there, but having a tilt towards it, if you bought just total US stock market index fund, you have very little small cap value in it. It's more large cap weighted. So if you want to keep it simple, buy the total US stock market index and then maybe 5 to 10% in small cap value separately. So you already have a little in the total anyway. It's all
Great.
interesting stuff that he
Appreciate
said.
that.
Let me see. He did a chart where I had it. Let's see. Yeah, this is a big chart. Um, just had it. Where did it go? Let me see if I can find it. It's maybe that's an open picture of it. I'll just zoom out of that. That zooms less. Why is zooming in make it smaller? This might work. Ah, I'll find it eventually. It essentially shows each decade, the different colors here are showing what was the best performing each decade. Small cap values, the blue ones. From the 40s to the 70s, it was just killing everything. And then 2000s, it did really well, made 50%. From 19, I think it's 10 to 2019, it was the highest performer. The pink ones here are the four fund combos. That's equal small cap value and blend, large cap value blend, and it lowers the volatility and you still get good returns. It actually beat out the S&P 500. That's the purple one here. So if you're willing to take a little bit more volatility, doing the equal weight on all those asset classes might be a better long-term run in a very long time frame, like decades, not 1 year. Interesting stuff. I was researching this stuff all over the place before I was even trading. A little better saying. Let's see. This keeps coming to this. I'll find it eventually. Yeah. The Bogleheads. I don't know if you ever heard of them.
Oh yeah.
They do the guide to investing, but they don't
He's the
really.
founder of Vanguard, right?
Yeah, John Bogle.
Yeah.
Mm.
I'm looking
Yeah,
more
they're
into income funds at
yeah,
my age.
yeah. This is the ultimate buy and hold. It tells the different weightings. I think they also do REITs for 10%. So you're essentially doing 10% on all of these. It's 10% emerging markets too. They're pretty big on international funds, which most people don't have nearly enough. I don't even have near. I have like 20%, I think, in small cap value. That's AVDV. This one, about 20% of my Roth IRAs in that, and then another about 3 to 4% in the blend one.
You know what's frustrating, Lance?
Yeah,
So on top of managing my money, I have a couple of accounts I manage. I manage my girl's account, right? And
yeah,
she's got a decent sized 401k.
yeah,
But the only options, not options, the only choices I have when I'm trying to distribute her money, around to invest it is long only mutual funds. There are no bear funds, which is
yeah,
criminal. It's they
yeah,
just force you to get into long only type of a situation where you have to either. What I do is I just get her out of everything. I sell out of the funds when I think it's a safe time to get on the sidelines. I mean, an unsafe time to get on the sidelines. But I don't know why more places like these that offer mutual funds don't offer the bear funds, because it allows the average investor to get on the opposite side of things.
yeah.
It's just rigged. I think it's just rigged. It's rigged to keep people in the market.
And charge fees. Have you ever heard of this book, How to Make $1 Million in the Stock Market?
Yeah, I've heard of it. I never read that one.
It's a buy low, sell high, pretty much. So you can look at different ways on if the market's high, RSI's high, all-time highs and whatnot. And then you essentially sell some of that and you put stuff into like bonds or other asset classes that are lower. And you
Mm-hmm.
just it's more of an automated, like once one thing goes up a certain percent, you take some out, you put it into the lower percent. And you
That sounds
just
like a decent plan. Yeah.
it's very mechanical. And then yeah, in terms of 401ks, they I think they purposely don't give many funds just for administrative costs on their end. So they don't want to have to deal with all that stuff. But yeah, I agree. I've never
Yeah.
seen one that's bear only. They're all long.
Yeah. They're all long.
I got to do research on my wife. She's just started a new job. She has the T. Rowe Price funds. So I got to see what they actually offer. I might just keep it real simple and just do the target retirement for like 25 years from now or something. I don't know.
Yeah,
But
T-Row's they've been around a really, really long time. They're good. Yep.
yeah, the
Just check the if it's a
expense
load
ratios are
fund.
relatively low, which is pretty much the most important factor, I think. You don't want to be in these high load mutual funds at high expense ratios. Because
Right, and make
people,
sure it's a no load fund. A lot of them are no load these days.
yeah,
No to get into them.
over 20, almost 25 years ago, I worked at Ameriprise Financial. They were like financial advisors from American Express. And then they were blatantly telling us we should be putting people in the loaded funds because we're spending all this time to research what is best for them. We should get paid for it. And then I was like, no, these low cost index funds will do better in the end.
Hmm.
And sure, we make less money, but it's better for our clients. And if you want to be a fiduciary to your client, that should be the way to go. And there was a clash ethically on that, so I left. And then I decided not to be a financial advisor anymore, and I'm teaching.
I don't blame you. If it doesn't feel right in your gut, you can't work there and enjoy your days when you go out there to talk to people.
Yeah, it's the another one is the whole life insurance thing. Should you buy a whole life insurance or buy term insurance and invest the difference in index funds? And the term and invest the difference almost always wins. And there's very few situations where you should buy a whole life policy. I'm not
Right,
saying that it's completely like negligible and don't do it, but and then
right,
they had the variable universal life policies, the VULs, where they're putting investments into an insurance product and charging insane fees. And it's just like the only person that would be good for that, you're a multimillionaire, you can't invest in retirement funds anymore, and you want to park money for insurance. Otherwise, it's not worth it for anybody. And yeah, that was it. So I just left.
yeah, it's a tough business, the insurance business, but it's lucrative, I'm sure, if you want to go with the in the unethical direction, like you're saying.
Right.
If you push what they're telling you to push, you can do well, but you also have to have sleepless nights when you get to be 65 and 70 and you regret all the
Yeah.
people that you screwed along the way.
One of my best financial decisions I've ever done. Once I got married, it was 14 years ago. Tried to get a term life policy. I figured out the weight that I needed to be to get the optimal rate on the premiums. And I was about 8 pounds over that. So I timed out when to have my physical with the nurse. And I just like ate beans and rice and nothing and worked out. And I just made the cutoff by like a pound, and that saved like ugh, thousands of dollars in the end because I have a 30-year term life policy for 500 grand that costs $320 a year, and that's nothing.
That was good. That was good on your part.
Yeah, just keep it, and then by the 30 years, hopefully I'll have a good enough account anyway, so it won't matter.
And you've kept the weight off, right?
No, I was one of the lightest I was when I was married. Then you get comfortable once you get married, right? And you start eating more.
Yeah, no doubt.
I did lose about 7 pounds in the last 3 weeks just from teaching because I'm walking so much. It happens every year where somewhere I'm lazy, and then when school starts, I'm like nonstop. I'm walking like 14,000 steps a day. So just that is good enough. And then it starts to level off soon. Yeah,
Always have time. You always have time to lose weight. Just don't get too unhealthy along the way. High blood pressure, high cholesterol. As long as those are in check, you can always lose
yeah.
weight.
I got the high blood pressure. I'm on quite a few meds. I gotta check in again. It's like they just keep switching the amount of meds I use. Oh, we're gonna move you to 25 milligrams instead of 50, and then that's like $200 for the cardiologist fee. I'm like, okay, you guys really have a racket going on, but whatever. Otherwise, it's pretty healthy. All right. Anything else you guys like to talk about? I know it's getting late.
No, I'm good, but it was good discussion again. Yeah, no, good stuff. You're always
Well,
working behind the scenes on hedges, Lance. You're gonna save the trading world one day.
hopefully. If anything, I offset losses and everything else. So I'll take being break even if volatility goes to 60 again. I would be pretty happy with that.
Well, I'll tell you, the VIX closed on a big up candle today. So let's see what happens the next following days, next couple days.
Yeah, the JOLTS report at 7, is it 7:30 or 9? I forgot. I think it's 9 o'clock, right?
What's that?
JOLTS report, it's a job.
I think it's in the afternoon, right? Oh, it's 10 o'clock.
10
10
o'clock.
o'clock Eastern time.
Yeah. The other things come out at 9:30 or at 8:30. The JOLTS comes out a little after. Apparently, the JOLTS report could change the market quite a bit. There was some back testing on it, and buying a straddle, pretty much buying a straddle right before the JOLTS report and closing it right after the report comes out might be a good trade. Although the last 6 months or so, it hasn't really done much. That's similar to an earnings type trade that you do.
Well, Nvidia got subpoenaed after the close today, so that's going to probably weigh on the market first thing too.
Yeah, they timed that out right after market close. People must have known about that. I mean, how is the market going to go down 9% on that before the subpoena? There's definitely some people that knew about it.
Tomorrow might be a good day to sell some puts though on Nvidia. 2 weeks out, 3 weeks, 3 weeks, 4 weeks out.
Hey, I'm looking more long term and might do a poor man covered call on my Roth IRA. I'm considering it.
Yeah, or that's go the long route. You could do that. Yeah.
I might do it where you go about 2 years out. You buy a put around, sorry, buy a call around 0.85, 0.9 delta, and then you sell around zero point 0.2 delta monthly calls against it. If it touches the sold call, then you could just get out of the trade at a pretty good profit or roll it out and wait.
And keep your eyes on AMD too, because AMD actually hired an AI expert from NVIDIA. So a lot of news in the semis tonight.
There's a YouTuber called Kamikaze Cash. He does interesting videos from like Wall Street Bets people. And someone got an inheritance for like 800 grand and he lost like 600 grand off Intel. It's like your grandmother literally just died and you're putting 600 grand into Intel. And then of course it plummets. Like, ugh.
That's a disaster.
Yes. All right, guys, we're gonna end it. It's getting late. It was great talking to you guys.
Yeah, man. Have a
Yeah,
good night,
thank you.
Lenny.
Yep. Take care.
Thanks for having the event. Appreciate it.
No problem. Have a good rest of the evening.
You too.
Thank you. Good night.